Okay.
Hello. So this is a fitting next interview because you were all just listening to emerging market talk in Africa and Frontier Car Group. That's sort of what you. That's what you do. That's what
Right.
your expertise is in. So Frontier launched about 3 years ago,
Right.
and in that time, you've gone from an upstart to a company that has what 750 million in annual revenue.
Right.
To now being owned or strategically invested in,
Right.
still independent, by a pretty huge company,
Right.
Naspers essentially. That's pretty fast.
Yeah. No, it's been a whirlwind. We incorporated in April of 2016. We launched our first market in December of 16. So about exactly 3 years actually. What's December 19? And yeah, we've been very lucky to grow how we have.
Are you surprised by the rate of growth that you've experienced? Was this something that you expected?
You know, I think that the rate of growth is, we've obviously been very pleased, but where the model works, we expected it. If it was going to work, it's going to work quickly. What I think has been the most surprising part is how ubiquitously successful it's been across the countries where we've tried it. You know, when we started FCG, I mean, FCG is a used car marketplace, very succinctly. And we operate now in 10 markets, but when we started, we operated in 4 emerging markets: Mexico, Nigeria, Pakistan, and Indonesia. And we thought, hey, maybe 2, 3 of these ecosystems would be conducive to the model. And all 4 and now 10 have just been magnificent, which has proven a thesis of emerging markets being ripe for disruption. But I think that's been the most surprising part.
Were in that first 4, were there any of those markets, you mentioned Mexico, Indonesia, that were either surprisingly easy to enter or surprisingly difficult? I think conventional wisdom is we think emerging markets going to be difficult.
Right.
What was that first year in those markets like?
You know, I think I'll give you 2 answers to it. Number 1 is operationally. I think that there's entering a country like Indonesia or Mexico, just understanding local regulation around tax, incorporating a company. You know, there's hoops that you have to jump through that are ridiculous and much harder than I thought in some, much easier than others. Easiest, for example, Mexico. It's even easier to set up a company in Mexico than it was in the US. But Indonesia, you actually have to go physically in person and present to a board on why you should have a company incorporated. And so there's different ends of the spectrum. The second answer I'll give you is actually in terms of topco fundraising. Because one of the biggest difficulties that I found is that raising and attracting capital for emerging markets in the very beginning of the company, before we have a proven business model, was very difficult. Because investors in the US and Europe are not keen on investing in these markets, or were not keen, should I say. That's changed quite a bit. And number 2 is there isn't really an ecosystem of capital in the markets we were in.
So what would since we probably have some, budding entrepreneurs in the audience, so how did you convince these companies, VCs in the US and Europe who might have been apprehensive to go into emerging markets, especially with the unproven company? What did you do? I mean, are you that convincing?
Yeah. I don't know about that. I mean, we've been luckily very successful in fundraising now. I think then, I think it was 2 things. Number 1 was diversification of risk. We basically, the fact that we would be spread across a few different markets, and frankly, if you could build and own the used car ecosystem of one of the countries in totally non-competitively ecosystems, it would justify the valuation times 10. And so I think investors got okay, not with the emerging market story, but actually with the diversification risk story. And then number 2 is, frankly, the way we're legally structured. I mean, we're a US company, and money goes into the US company, and then we hold subsidiaries. I think it made investors feel comfortable. And then number 3 is this, obviously, the just market opportunity is massive. I mean, these are 4 of the top countries in the world: market size, growth rate, used car markets, whatever metric you want to use. And so I think that was a no-brainer for investors.
You're a U.S. company, but you're based in Berlin.
Correct.
Right?
We're based just down the street. Yeah.
Okay. The most recent capital raise was $400 million strategic investment from OLX Group, which is really owned by Proteus, essentially Naspers. What was the backstory on that? I mean, have they been interested in you for a really long time, or what can you tell us that maybe no one knows of how that deal came about?
Yeah, so I mean, let's take one quick step back. I mean, we're a used car marketplace. We actually transact vehicles. OLX, for those who don't know, is the largest classifieds company in the world. They're our listing site, and so they are operating in 50 countries. They're owned by Naspers, which is a $110 billion company, and our products were hand in hand. Is people sell cars through us, and if they don't sell instantly, they usually list. And we operate in very similar markets, if not the same, most of the world. And so they had come to us about 18 months ago for our Series C, and they basically said, hey, listen, let's work together. For customers who can't transact through you, let's have them list, and vice versa. So they ended up investing $100 million for our Series C, and then now said, listen, this is working so well in the various countries we overlap, let's put in another 400. And so, yeah, they're our largest shareholder, obviously, by far, and we've just had it's been a pleasure working with them.
But you're still an independent company, correct? They own about, what, 70% of the company? Why did acquisition ever come up as an option?
It was an option, yeah, it was an option. I mean, we've raised now about $550 million, $575 million, and when we were thinking about this latest capital raise, we wanted it to be our last, hopefully. Obviously, there's interesting things we could do with more capital in terms of M&A, et cetera, but we said, should we do an external round from a normal VC growth investor, and we ended up getting a few term sheets to do that, or we said, listen, let's double down with OLX. And it was a big debate amongst our team, amongst our board, everyone, and what we said is there's two decisions here. One is financial and one is operational. Financial, these guys, Naspers, has under the radar as much capital as SoftBank does. I mean, the two largest investors in the world, I think. And so we said these guys are going to be our financial partners for life if we go with them. But more than that, operationally, there's hands down no better partner. We can reduce our marketing costs. We can get access to a #1 brand. And so it was worth getting somebody to take a majority for all of those upsides than taking a term sheet. And by the way, we had term sheets at higher valuations. But we decided still to work with OLX.
You said you mentioned in terms of you hope this is your last raise, which to me is like a hint that you're either on the verge of profitability or profitable. So are you profitable, and are you profitable in certain markets as opposed to others? Because you're in 10 markets now.
We're in 10 markets. We're in 5 countries in the Americas. We're in Nigeria. We're in 3 countries in Asia, and then we just launched Poland in Europe. A lot of our earlier markets are profitable. I think we're similar to a country that expands to more country, or a company that expands to countries where our earlier countries will be profitable. Well, we launched, for example, Poland last week, and so of course Poland is not profitable. But so I think that story is a little nuanced. But net FCG is profitable on an operational level, and we have a headquarters here in Berlin that's not, but over time we hope to surpass that. The second answer is that we probably, to be very honest, we probably will raise more capital with OLX, but the reason is more opportunistic. We are probably going to be expanding to more countries with them. As said, we're in 10 countries, they're in 50. And over time, we want to bridge that gap. And so as part of that, there's opportunities to buy or there's opportunities to build.
So a year from now, are you going to still be an independent company, or do you think that you will actually end up being fully acquired by OLX, or maybe some other
Right.
exit. I'm not sure. What do you think? Where do you think you're going to be a year from now?
I mean, I think it'll be very similar, where they're going to be our chief partners around the world. We're going to work deeply, co-create products, have unique blended customer experiences in our operational countries. But from a legal and governance perspective, I think we're still going to remain an independent, empowered team.
So your focus is on emerging markets, but I thought it was interesting that you went into the U.S., which most of us wouldn't think of as an emerging market. So why did you shift that strategy?
It's a good question. So we launched in the U.S. about 1 year ago, and we did that through an acquisition, our first ever acquisition, which was a business called We Buy Any Car. And it was a very large acquisition for us at the time, still is, and it's a highly profitable company.
Yeah.
So we don't.
So it's just opportunistic and.
No, it was actually for two reasons. Number one is we do the quote unquote emerging cities of the U.S.
Okay.
What we do in the U.S., we have 77 locations and growing, whereby we are in tier 2, tier 3, tier 4 cities in the U.S., where we help consumers within an hour transact sub $5,000 cars. So that's well below the average price point of a car in the U.S. So we don't compete with the Carvanas, the CarMaxes, the Vrooms. We're very much in kind of the emerging car, lower end car category. The biggest reason we actually did this, and this was a little bit of inspiration from Auto One here in Berlin, is for the first time we started cross-border trading. What we do in all of our markets is we're an auction house, right? We take cars and we allow buyers to bid on them. And a lot of these buyers in West Africa and Latin America, they craved supply from the US. And what it turns out that there is no good way for emerging market dealers and emerging market consumers to access vehicles from the developed world. Because insofar as somebody may have a cousin in the US who buys a car and then somehow finds a way to ship it, and that's really how it's done. Mm-hmm. So what we do now, for example, is we trade millions of dollars of cars every month from the US to West Africa. We have our same dealers bidding on cars that are being sold in Nashville, Tennessee. And then we do the end-to-end logistics from Nashville all the way to Lagos, Nigeria.
That seems like it would really crush your margins, bringing something all the way to between the U.S. and West Africa. I mean, I live on the border of Mexico and in the U.S., so to me, I see a lot of cross-border traffic. That would seem to make more sense. So how does that pencil out when going all the way to Africa?
We make more money on those cars than the cars we trade locally.
Really?
I mean, net of everything. Yeah. Because if you think about it, the quality of these cars is extraordinarily better than the quality of a car for the exact same spec you'll find locally. And so a 2010 Camry that's been driven on a US road versus been driven on a Nigerian road is going to be vastly different. And so it goes for a much higher price, net of logistics. And by the way, logistics isn't actually that expensive. And so it's just about coordinating the process, financing, putting insurance on that. But if you can coordinate all of that, there's a lot of money to be made.
So essentially the U.S. is operating as almost like a feeder market, feeding other emerging markets.
Right.
It's not going the opposite way, I would.
No. Yeah, we don't send anything to the U.S. We only go out of the U.S.
So is Poland going to act as a similar strategy for you, because it was interesting to me that you went to Europe.
Right.
Again, something I wouldn't consider as an emerging market. So is Poland going to be this sort of feeder market? So it's going to be bringing cars to African nations?
It could be. It could be. When we define the word emerging market, of course there's the definition a developing world. But for us, we really think about emerging markets as the characteristic of the used car industry there, rather than if it may just be traditionally an emerging market. So, for example, the consumer pain point in these markets is that it's just a terrible experience selling your car. You can list on classifieds, you could try to negotiate with a dealer. That's really it. And so if that pain point exists in a developed market, that's still an opportunity for FCG. And what we found in Poland is because so many cars are imported already to Poland from Western Europe, that there's not really a good way for consumers to sell their vehicles. Dealers have enough supply, classifieds aren't great to work with. So that's the opportunity we saw in Poland is actually a domestic market where about 1 million used cars are sold every year. So we actually want to consider that a domestic market first, but over time we probably will do mostly to Africa trading.
With this capital raise, this 400 million injection, that gives you, I would think, a lot of runway to expand into other markets. So are you going to be focusing on, I mean, are you going to go to Canada next or some of these other, like what you would think of as non-traditional? Or are you going to focus on Africa again, Asia, or Latin America?
So our FCG's really core group of countries is Latin America, Africa, Asia, period. And we've always operated under let's be focused. Let's not expand too quick. Let's be reasonable. I mean, we could do the spray and pray approach and open 40 countries and see what works. But we've been very level-headed, and I don't think this investment will change that. That being said, we have an unfair advantage with OLX now, which is when we enter a country where OLX is present, we instantly have a group of consumers, a marketing engine, a dealer database, a brand, everything set up for us. So that being said, we'll probably launch 1 to 2 new countries in 2020. One of them will most likely be Brazil. And so Brazil will probably be our next foray. It's a massive market, top 10 country, top 10 used car market. There is some nascent players that have started there, and so we're considering buying versus building right now.
Okay.
But that would probably be the next, and then maybe a little bit of expansion in Southeast Asia.
Brazil's an interesting choice because in terms of new car sales, Brazil and some other countries in South America have just crushed automakers. They've completely pulled back. So, kind of a two-layer question. What's the used car market like in Brazil? And also, what's the startup market like in Brazil since you're looking at an acquisition? I'm assuming, maybe incorrectly, that you're going to be buying up maybe some smaller companies, not some big one. So what is Brazil like? Yeah. What's the status?
Well, I think let me answer your first question on the used car markets, because frankly, the new car markets in a lot of emerging markets are just getting crushed. I mean, crushed. And they're so expensive. If you think about a car, just a car is such a large piece of somebody's income. It's somebody's net worth in an emerging market, because it's not like the price of a car changes. In fact, the price of a car is typically more expensive in an emerging market than the developed world. Like, for example, our average car cost in Indonesia is about $12,000. I mean, that's for a 2008 Toyota. And because there's a lot of import taxes on new cars, so then the value carries through. So people can't afford new cars. But used cars are rising in terms of growth of the industry at the fastest clip in emerging markets, because you have this middle income population that's getting more and more empowered. Like GDP per capita is going up and up and up. And so more people can buy cars, but they can't afford new cars. They can afford used cars. Right. And so what we find, in particular in a place like Brazil, is that the growth rate of used cars is nearly double digits. And I think that's spectacular. That's a spectacular opportunity for us to be in the trade of used. So the second question is doing work in Brazil. Brazil is a notoriously hard country to do startup work in. I mean, payment cycles are broken, et cetera. But it's such a large ecosystem. It's such a large market. There's so much venture capital activity there that it's a great opportunity. And frankly, the dynamics of why it makes building in a country is hard gives us a competitive advantage. That's the case around the world. No one builds in Nigeria. I mean, I shouldn't say no one, but very few people build in Nigeria. We do, and therefore we're the only used car player that exists.
So to wrap things up, you have sort of set a course to do 3 different types of businesses: the buy to sell consumer model, the selling and buying for fleets, right? But then there's this third layer, this kind of trying to be the next Kelley Blue Book, which is this all these services layer. Is that the next big opportunity, in the online used car marketplace to go after that third piece?
I think it's huge. I mean, financially, it's also amazing, because if you think about it, in the US or in Europe, if you want to know how much your car is worth, you can pretty much easily find out. There's a lot of tools at your disposal. But in emerging markets, you don't know, because there's no definitive pricing guide. because pricing guides, people may not know, but are usually built on top of real live trading data. But if there's no trading data, how do you get that? And so if you can be the de facto way cars are traded, which we are in most of our markets already, you can build the biggest portal of actually pricing information. And these, by the way, financially are pure EBITDA businesses because there's no cost. And so, yes, I mean, I think once we're ready to build that and monetize it, et cetera, we will launch it. We probably already have the data for it. But yeah, I think that's what we look in 5-7 years as being our biggest opportunity.
Okay, great. Thanks so much for joining us.
Thank you. I really appreciate it.